very important. Practically very important because these fluctuation of lending standards, we know that these fluctuations also trigger fluctuations in the economic cycle. So if you want to stabilize the economy, one of the things that's important is we need to try to stabilize the behavior of banks. We cannot have banks that sometimes, lend to everybody and sometimes just cut lending to everybody, because that's then, leading to these economic fluctuations, which create a lot of deadweight loss. So let me see if I can change the slide. So this is the paper co-authored with Yip. He is in the call and will be able to answer some technical questions, I hope. And Ms. Hang, both from Foreign Trade University in Ho Chi Minh. So we basically addressed two questions. Why are the lending standards pro-cyclical? So why do banks sometimes lend very freely and sometimes not? And why are these lending standards pro-cyclical, even if you adjust for the riskiness of the firms? So firms with the same risk in an economic upturn and in economic downturn, we know that in an economic downturn, even if the firm itself is not affected by the economic downturn, banks will tend to give less credit to these firms in an economic downturn. So that's the first thing we try to explain. This is a well-known observation. I have a whole list of papers who have documented these fluctuations of lending standards. And then we try to explain a less well-known fact, but which also has been documented quite widely now, and that's the fluctuation of lending distances. So when banks reduce their lending standards, so lend more freely, it turns out they also tend to lend to firms that are further away from their headquarters. So we can see that in an economic expansion, they also expand the lending distances. And then when the economy turns, then they shrink the lending distances. And we connect these two things, and we provide, if you want, a unified theory for why we observe these maybe surprising facts. Now, there is a number of, not the first one, of course, to explain this. There's a number of papers who have tried to explain these observations. The most frequently made argument is that this is simply about short-termism and irrationality. In the same way as a stock market bubble is probably driven by over-optimism and irrationality. The bank's behavior can also be influenced by over-optimism and irrationality, and that can then lead to these fluctuations. In economics, we don't really like these explanations, because if you just explain this irrationality, you can explain a lot of things. So it's not a very useful explanation. But there are other explanations. One explanation I think that is complementary to our explanation is this paper by Martin Roques, where he shows that these fluctuations in lending standards, he doesn't talk about distances, lending standards can be explained by screening incentives. Can you hear me? Yeah? Okay, I think so. So what's the idea here? I think actually quite a simple idea. So what he shows is that so screening is, as Zhang pointed out, is the credit worthiness test before you give a loan. So that's what the bank does before paying out the money. Monitoring is what the bank does once it has given the loan. So screening incentives, if the economy is very good, it's actually not very profitable to invest a lot of time in credit worthiness test, because basically most companies will be reimbursing their loan anyhow. So in very good times, what the banks will do, they will not screen a lot. They will not carry on very careful credit worthiness tests, and then they will just lend to everybody. In very bad times, the opposite happens. The same thing happens for screening. So because most companies are bad, it's actually not profitable for companies to screen, because they will not be able to identify a lot of good companies with screening. So actually, they will not screen, and then they will just not lend to everybody. Okay, and only in normal times they will screen and then lend to good and not lend to bad firms. So you get this kind of fluctuations in lending standards as a consequence of the fluctuations of the screening intensities. No screening if the economy is very good, but a lot of lending. No screening if the economy is very bad, but no lending. Our explanation is in some sense similar, but relies on monitoring. Now, there are other explanations. Availability of loanable funds. In good times, savers save more, than banks have higher deposits, and that, of course, leads to larger availability of loans. There could be changes in the way banks compete in good and in bad times. And finally, there is an old explanation that relies on the bank's franchise value. So basically, the present value of the bank's future profits. So if the bank's franchise value is very high, if the profits are very high, they could be able to take more risk and therefore lend more freely. And if the franchise value is very low, what is going to happen normally in bad economic environments, then have lower risk taking. Lower risk taking will be possible, and that will then lead to lower lending. Okay, so there's a range of alternative explanations, but I think that most of these explanations cannot really explain the distance part. Okay, why would the lending distances fluctuate with the economic cycle? So what we say here is that what probably happens is the explanation we try to construct is that what happens is probably that the monitoring capacity of banks is limited, and the need for monitoring will fluctuate with the situation of the economy. So if the economy is very good, most companies will be very good, and then it's really not necessary for the bank to visit the company, to try to understand the business model, to give advice, and also maybe to control that the company is not doing anything stupid. However, if the economy is not so good, then this becomes important. Then the bank can really contribute to the value of the company, and potentially lending will only be possible if the bank knows that they can supervise the company, because otherwise, without monitoring, without control, the danger is too big that the company is just going to waste the bank's money. Okay, so that's the key of our explanation. So in bad economic times, the need for monitoring is much higher. Banks cannot easily expand their staff and the time that is available for monitoring, and therefore they have to ration monitoring, and as a function of rationing monitoring, they have to ration bank loans, in particular to certain types of borrowers. And that's what kind of borrowers will be rationed. That's what we are trying to explain with the model. And then we try to find these patterns in the data. As basically a side result, we also show that monitoring does actually substantially decrease a company's default, a firm's default risk. So we have in our database information on monitoring, and we can see that the more frequently the bank visits the company, the lower is its default risk. And I think we are almost the first one to demonstrate this. We can also show that if we look at how does monitoring change as a function of the geographical distance, we see that the further away the firm is, the less monitoring the less frequently the bank will visit the company. It makes sense because simply traveling is expensive and time consuming. So if you're lending to a company that's very far away, you will not frequently visit it. And that, of course, translates into lower monitoring intensity and therefore probably higher credit risk. Okay. And our final results is that actually during an economic downturn, the monitoring becomes more important for firms that are close by, and even less important for firms that are further away. So banks are concentrating the monitoring activity towards the firms that are in their immediate neighborhood, if you want. Okay, and theory is that, I mean, in bad economic times, they have no time to waste to travel to the far out borrowers and to supervise them. They have enough to do to just monitor the firms that are easily available and that they can be easily monitored just in the neighborhood of the bank's headquarters. So that's in a key the theory, and I was at first very convinced of the theory because I think it sounds, you know, intuitively appealing, but it turns out it's not so easy to model. So when you go through the modeling effort, you will actually realize that this seemingly intuitive explanation requires a number of assumptions that are not immediately visible. Okay, so so again, as Zhang already anticipated, I think an important side effect of this paper, or side result of this paper, is that it really draws attention on the monitoring aspect of what banks are doing instead of only this screening aspect. I think that's important because in the US, there is a very strong tradition of discouraging banks from intervening in the firm's affairs. I've just read an article again about this. Okay, so if a bank directly gives instructions to the management of a firm in the US, the firm can sue the bank, okay, and the firm's other creditors can sue this bank and make it liable for the firm's losses. So in the US, because of these legal restrictions, okay, banks are extremely reluctant to monitor in an active way the firms. Okay, in the US, you have investors that do monitors, but these are, you know, venture capitalists and these are private equity firms, and there is some evidence on the fact that, you know, the fact that these venture capitalists visit their investments does create value, but banks traditionally are not allowed, if you want, by the legal system to actively contribute value to the firms. So this is, I think, why monitoring, I mean, a lot of the literature in banking is US centered, and this is why I think the monitoring aspect of banking is really under researched. But I hope that one of the messages of this paper is that monitoring and the ability of banks to monitor firms is really a key ingredient of lending, and of course, in particular, of lending to SMEs and maybe also of lending to companies in emerging markets, where really very little advice on how to make a business plan or how to organize your sales function and so on. So very simple advice can already create a lot of value for the company and avoid bankruptcy. Okay, so that's a bit of the background message of the paper, but our key result is, of course, the attempt to explain these fluctuations in lending standards and in lending distances with the monitoring capacity and the monitoring activity of banks. Okay. So please, I should have said this, but please interrupt if there are questions. It's a very preliminary version of the paper, as I realized when I prepared this talk. So I'm always happy for new ideas, for suggestions, for questions. So I don't know how you organize, but you can just, I think, raise your hand in the Zoom call. Okay. So there are no questions. Let's move on. Okay. So I've already given you some literature here on the fluctuations of geographical distance and the dependence of monitoring on the geographical distance. Here is a list of papers that have done this. I mean, there's a whole literature now on, you know, lending and geographical distance. But actually, the aspect of monitoring in this literature has not really been fleshed out, I think. I mean, it's a lot about information asymmetries. The further away, the stronger are the information asymmetries. But how these information asymmetries then really enter into the borrowing risk is not clear. Okay. So I've said that indeed monitoring is not really a research topic in the US, but there are some papers. You can see I have to go far back to the 1980s. There are some papers that do mention this, the fact that a bank can positively contribute to the firm value. This is sometimes called the helping hand hypothesis. There's a list of papers here on that. I mean, there's two ways of viewing what monitoring is really about. One view is that monitoring is just, controlling what the firm is doing. For example, verifying that all the covenants are fulfilled. This is something that, of course, even in the US, the bank is allowed to do, but it's not sure that this is really contributing massively to a reduction in firm risk. So what we try to argue here is that the key effect of monitoring is not really the control part, but this positive, helping hand part, where banks actively provide advice to the company to reduce the credit risk of their loan. Okay. Now there is two very recent papers that I think are quite interesting. They're difficult to find, but because apparently they are working papers that are still changing a lot. But they provide direct evidence on the fact that actually the monitoring capacity of of bankers is limited. So, for example, this Donovan Martin paper shows that if bank managers are distracted because there is a problem with other firms in their samples, but suddenly the firms in very different industries that are not affected by the same problem, they are also increasing their firm risk. And they claim that this is because the bank manager now needs to concentrate on the one firm in his portfolio that has the problem, and he's neglecting the other firms, and therefore the other firms also start having problems. So that's basically a direct confirmation of our key assumption that banks have a limited capacity to monitor firms, and if more and more firms need to be monitored, such as in the economic crisis, then they will have trouble, monitoring everybody. Okay, now let's start with the model. Okay, so I think it's a very simple model. It's not a game theory model. It's a micro model in the tradition of a German economist, von Thünen, who has initiated these geographic models. So we had a ring model that showed that as a function of transportation costs around a city, you will have different types of industries or different types of agriculture evolving. So you have very close by, you have the high value added products that cannot be transported for a very long distance, and that's as you go away farther from the city, you will have different crops that are less value added, have an easier can be more easily transported. So that's our kind of model here. It's I think a little unusual, but we have thought a long time about what kind of model would be appropriate for this kind of situation, and that's what we've come up with. So what do we have? So we have a very simplified idea of what a firm is. So a firm is simply characterized by a default risk, P, a loan size, L, and then, of course, a distance with respect to the banks. We don't model competition, so we just assume that there is an exogenously fixed interest rate, R, that the bank has to require on the loan. Maybe for Vietnam, not an absolute assumption, given that interest rates are capped. Now, how does monitoring work? Monitoring is in our model a fixed, so it's not you cannot decide about the quantity of monitoring. Either you monitor or you don't. So it's a 1-0 decision. If you monitor, you will reduce the firm's probability of default P by a proportion Q. Okay, so the new, and Q is of course smaller than 1, so the new default probability will be simply P times Q. Okay, so this is of course not for free, so it requires monitoring costs, and the monitoring costs can just be viewed as the time required for monitoring, that's M, the time required for traveling to the company, because you have to be there, it's T, and then times the wages of the bank employee who carries out the monitoring. Okay, so you get a fixed cost of monitoring, and this fixed cost of monitoring is increasing with the distance. And then, of course, the key assumption is that the overall capacity to monitor firms is fixed in the short term. So this is our firms, very simple. Now, what's the lending process? How does it look like? Initially, banks will screen borrowers. We don't model this, but when they screen borrowers, they will learn the probability of default P as a function of the probability of default and the distance. So there's no asymmetric information. As a function of these two parameters, banks decide whether they want to give a loan or not. And of course, they anticipate whether they need to monitor the firm or not. So if the firm is successful, then the bank will be reimbursed, and it makes 1 plus the interest rate times the amount of loan. So no, it gets back 1 plus interest rate times the amount of loan. Of course, it has invested the amount of loan. We assume that opportunity costs of lending are 0 for simplicity. So success payoff is 1 plus R times L. And in failure, we assume that loss given default is 0, collateral, again, for simplicity. So they just make, they lose the entire. Okay. Now, how will the banks decide whether to lend and whether to monitor? It's pretty straightforward. Okay. The lending decision depends simply on whether the expected profit will be positive with or without monitoring. So to the left-hand side, you have 1 plus R multiplied with L multiplied with 1 minus P, which is the expected success payoff. Remember that P is default probability. Okay. So this is the expected success payoff. Remember also that in the case of default, which arrives with probability P, payoff will be 0. This will be the expected, payoff minus the initial cost of providing the loan. That's L. Okay, so on the left side, we have the profit without monitoring, and on the right side, we have the profit with monitoring. Okay. Again, same intuition. Okay, so 1 plus R is the interest rate plus the initial amount. Okay, and then with monitoring, the default probability is decreased. I think I made a mistake in the previous slide. Okay, so the default probability decreases by 1 minus Q. Okay, so this is a smaller default probability and therefore a higher success probability. You still have to provide the loan, of course, and then you have the monitoring costs, which have to be paid. Okay. So if either one of these terms is positive, then monitored or non-monitored lending is profitable. Now, how can we know whether the bank will be monitoring? We just have to compare the left side of this term to the right side of this term. And this is then the incentive constraint for monitoring. Okay. So it's all relatively simple, and I think the best way to understand what's going on is to look simply at a graph. So what I've done here is I've fixed the amount of loan to 80,000. Okay, probably not dong. I don't know what there's no currency in this model. so to $80,000 probably to make it more realistic. And then we have the distance. Okay, I don't have a unit here, but that's basically a measure of the traveling costs. Okay, and on the left-hand side we have the default probability, and that goes here from 5% to 30%. Okay, so that's of course the non-monitored default probability. Okay, so we have basically three areas here. Okay, we have one area where non-monitored lending is profitable, simply because the default probability is low enough so that given the fixed interest rate, the bank will make an expected profit. Okay, so this is simply this lower bar here. Now, the fact that non-monitored lending is profitable doesn't mean that the bank does not monitor, because potentially monitored lending is even more profitable. And that's actually what we see here with this incentive constraint. So this is the incentive constraint for monitoring. Banks, companies that are above this incentive constraint will be monitored, and companies below will not be monitored. Okay. And then, of course, if you're monitoring, the default goes down, which means that we can now lend to companies that are much more risky than if we did not monitor. So this is the participation constraint. Okay, that's the line that separates the firms for which no lending is profitable and the firms for which the monitored lending can be profitable. Okay, so I mean, this all is very intuitive. So we see that indeed the close-by firms, a large fraction of these close-by firms will be monitored simply because monitoring is not very expensive, and then as monitoring costs increase with the distance, less and less firms will be monitored, and at very far distance the bank may still be lending, but of course then there's no more monitoring. So the bank will have to concentrate its lending activities on really safe firms that they can lend to even without monitoring. Okay, so that's the graphic representation of basically what we have done here. Now you can also cut the situation as a function of the loan size and the default probability for a given distance. What's the time? I think we're moving along quite a bit. This is less relevant. Okay, no comment, I guess. No. Okay, so let's maybe skip that graph because of time constraints, but it's not going to be very important for the rest. Okay, now for the moment we haven't made any assumption about the distribution of borrowers in this space. We have just indicated what would happen to borrowers that are situated in one of these areas. Okay, but now of course we have to model somehow what happens if the risk of the borrowers increases. So we have to think about. I mean, we want to model the effect of an economic shock on monitoring, and an economic shock will simply be represented by an overall increase in risk. Okay, in our specification, we just add a factor delta or a term delta to default probability. So if the economy enters into a recession, we just assume that there's a fixed amount that's being added to the default probabilities. And then we want to see how will banks reallocate the monitoring capacities. Okay, so the idea is that in a normal economy, they will build up the monitoring capacity that is necessary to satisfy this monitoring lending that we see here. But then in an economic crisis, risk will go up. The demand for monitoring will go up, but the capacity constraint will bite. And therefore, instead of increasing the supply of monitoring, if you want, banks will have to reallocate monitoring differently across the mass of firms. Okay, so you have to somehow make an assumption of how firms are distributed in this, risk distance space. And this is what we do with this distribution function FPLT, which is the density of borrowers in this three-dimensional space. Where we have three parameters basically: the risk, the size, and the distance. Okay, so we assume a continuous distribution of borrowers, which is a technical trick essentially to not run into thresholds and integer problems. Okay, and we assume that for simplicity that the mass of borrowers that is available is equal to 1. Okay. We also make the assumption that the distribution of risk and size, so the type of companies that are available, is doesn't change with the distance. Okay, is constant with respect to distance. So that's this assumption here. Okay, so for T or T2 star, okay, I think there should be a T2 star also in the denominator. I have to check that. No, it's an integer. Okay, so the distribution shouldn't change with distance. And finally, we have an assumption which is not necessary for all our results, but for simplicity, we just introduce it here. And this assumption is that the mass of firm decreases with risk. So the further you go out, the fewer firms are available. So the more you increase risk, the fewer firms are available, and the further you go out, so the further the distance, the fewer firms are available. So that's formulated by these two derivatives. So the derivative with respect to P and the derivative with respect to T are negative, which means that these distribution functions are sloping off with risk and time, with risk and distance T. Travel time. Okay, good. Now we summarize our results in two propositions. So the basic properties of the model, actually, in two propositions that we then try to test. So in order to formulate these results, we also define this indicator function for lending, L, which is 1 if the company will be lending, and the indicator function for monitoring, M, which is 1 if the company is lending and monitoring, and 0 otherwise. And then we can formulate our first proposition, which is a very straightforward result, which just says that on the set of firms that are awarded a loan, so the set of firms for which the indicator function L is 1, monitoring weekly increases. It cannot strongly increase because the indicator function is only 1 or 0. Weekly increases in loan size, interest rates are and firm risk, and decreases with distance. Okay, I mean, that's a very straightforward property. The larger the loan, the higher the return on monitoring. Remember that monitoring just decreases the probability of default, and of course, if you have to lend more, then this more. This pays off more. This reduction in default probability pays off more. Higher interest rate, same intuition, get back more, therefore it's more profitable to monitor. And of course, the key property, the riskier the firm, given that the reduction in risk is proportional, the more profitable is monitoring. And finally, distance T, of course, monitoring costs are higher. So at some point, monitoring will be too expensive, and then it will decrease from 1 to 0. Okay, so these are the straightforward properties of the model. There's really no need to prove this. But now let's move to the second, more complicated proposition, where we try to model what happens. How do banks reallocate the monitoring capacity if simply the risk of firms increases from its original risk P to P plus data. Okay. Now I've reunited three properties of the new distribution of monitoring here. So the percentage of monitored firms will increase at close distance and decrease at high distance. That's okay. So that's this idea that the banks will concentrate more on the firms that in the direct neighborhood. The average distance between banks and the borrower will decrease. So that means that some of the borrowers that are further away, they will become unprofitable because now monitoring is too expensive for these. So they will be dropped. And overall lending standards will increase, which means that firms that would have received with an overall risk that would have received a loan before now will not receive a loan simply because without the increase in the risk, without the economic recession, these firms would have been monitored and would have received a loan. Now there is not enough monitoring capacity, and therefore these loans have to be dropped. Okay, so what's happening graphically? It's now getting a little bit complicated. Okay, so if you remember, this is where we started from. Okay, and now we are just adding data to the risk of all firms, which means that we're basically shifting these blue and gray spaces upwards. Okay, and that's what we have here. Okay, so we can see here is the delta. This is the increase in the risk. In this case, it's 0.05. Okay. Now, of course, this directly makes certain loans non-profitable. So these loans will be immediately exited. Okay, but it will also lead to a reallocation of monitoring. Okay? And what is key is, of course, now here the fact that there are more safe firms than risky firms. Okay, so when you shift up everybody's risk, suddenly a lot of formerly safe firms become risky and need to be monitored. There are, of course, other firms that were previously monitored and that now are so risky that even with monitoring, they cannot be provided loans. But the mass of these firms is that will drop out of the loan portfolio because even monitored lending is not possible anymore. The mass of these firms will be smaller than the mass of these firms that newly need monitoring. Okay, and that essentially increases the demand for monitoring, and given that the supply for monitoring is fixed, okay, we have to ration monitoring, and that's what happens here. Okay, so the dotted lines, the black graph here, illustrates what the firms that have been monitored before, and now given that the demand for monitoring has increased, we can only monitor these firms in the new blue triangle, so lower quantity of firms. Okay? And from this graph, you should normally be able to directly infer our three properties. Okay, so percentage of monitored firms will increase at close distance and decrease at high distance. Okay, so you can see that the slopes of this new monitoring triangle is stronger. Okay, so that means that there is more monitoring in the close by firms than in the far away firms, and that's more monitoring the close by firms than before the economic shock increased everybody's risk. Okay, so and you see that at the further out, okay, in these areas, of course, monitoring decreases or disappears, okay? And that is basically the intuition for our first result. Average distance between bank and the borrower will decrease. Again, you can see that these gray areas, in these gray areas, loans will be exited. You can see that this means that more distant loans in this area will be exited than close loans. So that means that lending becomes more concentrated. And finally, we see that lending standards will increase. But for example, these firms here would have received a monitored loan without the economic shock, and with the economic shock, they cannot be monitored anymore. Monitoring is just not profitable anymore, and so we will drop monitoring for these firms. Okay, so that's the model. Are there any questions on the model? I'm highly interested in comments and questions on the model, because it's a bit of an unusual model. Yeah.
Yes, actually, normally we leave the question until the end, but I think that we prefer interactive exchange. So actually, I have some questions.
Go ahead.
Already, it seems that if I understand correctly, banks in any case cannot exceed a given loan, right?
Cannot, sorry?
Cannot exceed, they cannot stop giving loans.
Yeah, no, I mean, that's a good question, because there are two, I mean, in the previous version of the paper, I had two scenarios where the risk increases, but banks cannot exit loans, okay? And in this case, it's quite clear that there is not enough monitoring capacity, because the loans that had needed monitoring before the increase in the risk will still need monitoring, and then there are additional loans that need to be monitored, okay? Now, it's not obvious that this will also happen if banks can exit the loans that are not profitable anymore because they don't have enough monitoring capacity. And that's why actually we derived proposition 2. Okay, so I simplified, if you want, the model a little bit, and I focused only on the part where banks can exit the loans that are not profitable anymore after the increase. But if we want the monitoring, the demand for monitoring to increase, even in that situation, we have to assume that there are more safe firms that become risky than risky firms that drop out of the portfolio. Okay, and that will happen if there is a declining density with risk. Okay, so if in the portfolio you have more safe firms than risky firms, and now you increase the risk for everybody, okay, some formerly safe firms will need to be monitored. Actually, these will be quite a lot because the density is very high there. And then some formerly risky firms that were still profitable will become unprofitable even if monitored. Okay, so the fact that these firms drop out of the loan portfolio will release monitoring capacity, but this will not be sufficient to satisfy the supply, the demand for monitoring, because there's more firms.
I didn't hear anything.
I guess that there is some problem with the connection of the speaker. Let's create a feed. Oh,
I think you have been disconnected. Yes.
Yeah, we couldn't hear you for a few minutes.
A few minutes. So you missed the explanation. I'm not sure it's a big, a big loss. Okay, but I mean, so to give you a short answer, in this version of the model, we do allow banks to exit the loans that have become not profitable, and we add an extra assumption which makes sure that despite this, the monitoring capacity is the demand for monitoring increases.
So my question is, how realistic this assumption? Because I have to say I don't
probably not terribly realistic in the short term, but if you remove it, then the argument becomes even stronger, because then it's even clearer that an increase in the risk will, lead to an increased demand for monitoring. I mean, that's what I said before. If you increase the risk for everybody, the banks and the firms that needed to be monitored before the increase in risk still need to be monitored, and then you have new firms that need to be monitored that before the increase in risk had no need for monitoring. So overall, it's obvious that the demand for monitoring is going to go up.
So for the definition of monitoring here, it means that we check the let's say financial ratio of the company to see if it's within recommended range for that finance indicators, or how do they do the monitoring?
So there was a problem. Can you repeat the question? That was it actually.
Yeah. So my question is, what is the condition of monitoring here? What do they do?
No, I mean, the bank looks at the firm, and if the firm looks shaky, if you want, I mean, that's probably based on some formal criteria that some numbers that can be sent off the internet or can be discussed on the phone. If the firm looks shaky, so that means they have this high default probability. Then they will decide that they need to send somebody and look into what's going on there.
And do they have some controlling right over the?
No, there's nothing. I mean, no, there's no. I mean, it's SME lending, so I think that in any case they can always threaten to take back the loan, because there's always some covenant. I think these loans are mostly without an explicit maturity, or they can always be cancelled before the maturity. But that's something that maybe some of you know more about. What is the exact, how does SME lending in Vietnam work? My understanding is that, these loans can be, if the bank thinks that the company has become too risky, then the loan can be recalled. Even if the company cannot always reimburse the loan, the bank can try to shorten the maturity.
Yeah, so maybe we can clarify further about the real condition of lending in Vietnam, especially for SME.
Yeah, I think that's good.
Yeah. And I think you can reshare the screen because
I have forgotten.
It's lost after the
Of
connection.
course. Okay.
Thank you.
Okay. So that's the idea. I mean, so the takeaway from the model is really the intuition is, I think, simpler than the model, but it turned out to be, and I was really surprised that it was quite complicated to model this intuition, which a priori seems simple. In a crisis, you need more monitoring, and if you don't have more monitoring capacity, but then you will just focus on the nearby firms, because you cannot waste money for travel, and you cannot waste time for traveling too far away borrowers. That's the message. Let's look at the data then, because time's running already. So we use this survey of small and medium-scale manufacturing enterprises in Vietnam that has been collected by a number of international bodies and Vietnamese government institutions. This is a very detailed survey which we have exploited for several papers, and it is collected biannually for the years 2015 to 2005 to 2015, and it covers the data years 2004 to 2014, again biannual intervals. So the questions we exploit for this empirical part is how many times in the year preceding the survey did your bank assist in issues related to, and then you have a list of different issues, okay, such as manufacturing, technology, marketing, cooperation, credit, contracting, and administration of the firm. Okay, so how many times? Okay, so the numbers vary quite widely, but we cut it at 13. So we assume that it's unrealistic that the bank is visiting or advising the company for more than once per month. And I mean, there are some outliers, but essentially most replies are between 0 and 13. And that will, of course, be our measure of the monitoring intensity of the bank. And it's something that, I mean, I think we are the first one to really have this explicit variable on how much time does the bank spend on the company. Now, the second question we have explored is, there's two questions actually, which give us some information about the distance between the company and its nearest borrower, okay? Sorry, the nearest lender, the most important lender, sorry. So the first question is really about explicit distance. So is the most important creditor located at under 5 kilometers, from 5 to 10, 11 to 20, or more than 20 kilometers? So we just code this as a variable called far that takes the value from 1 to 4, depending on what category the distance is located. And then we have a second variable, which is about the district. So is the most important creditor located in the same district or not? And this is our second proxy for the distance between the lender and the firm. Of course, that's in theory less precise, because they could be just on one or the other side of the border of two different districts, but actually this variable will turn out in many cases to be better than this explicit distance variable. Okay. Now, then we have, of course, a number of control variables. Here's a list. Yes, so let me just, so one variable, of course, is the crisis variable. So this is supposed to measure this increase in risk. And here we take the years 2008 and 2012, which, as you all know, are years when the economic situation in Vietnam was not great. We can also see that these are the years where the default rates spike. We have the frequency of default. Okay, so this is a variable that indicates that the firm has in the past delayed payment on the debt. We have the interest rate, we have the amount of the most important loan. We know whether the loan is collateralized or not. We have a sales number for the firm. We have total assets, we have leverage, we have return on assets. We know whether the company has invested in the last year in its total assets. And we have some personal variables on the CEO or the manager owner of the company: age, education, gender, and the question whether he's ethnically Chinese or Vietnamese. Okay. So how do we want to test our model? We have basically 3 steps. Okay, so we want to first test our model assumptions on the fact that monitoring will reduce the risk of firms. And then we try to figure out the determinants of monitoring. So is monitoring indeed increasing with loan size, decreasing with distance, and increasing with risk? And finally, we check this proposition 2. So how does the monitoring intensity and how does monitoring intensity change with distance and with risk? So how is monitoring reallocated in an economic crisis? Okay, let's look at the tables. So here we have the summary statistics of our main variables. I think that's pretty straightforward. Just maybe look at the average value of the monitoring variables. It's about 4. So I mean, that shows you that banks do actually provide quite a bit of active advice to companies. Yes, the remaining variables I think are straightforward. Okay. Then we look at univariate comparisons, and here, surprisingly, we don't find much. Okay, so this is the number of firms that were monitored from 0 times to 13 times, and you can see that all of these categories are relatively well. I mean, we have meaningful numbers for all of these categories. Interest seems to be almost flat. I mean, all the other variables actually are almost flat with respect to the monitoring intensity, which is not what we would have expected. But you will see that this is different when we look at the multivariate analysis. So in the regression, you will see that the differences will show up, probably because I mean, there are these interdependencies between the distance and the monitoring intensity and the risk of these borrowers. Okay, so let's look at our first main regression. This is our first key regression. This is the regression where we just relink the frequency of default to monitoring and control variables. And this is a very nice result because we can see that monitoring has a significant and negative effect on default frequency. Okay, so that's not a prediction of the model, that's actually the assumption of the model, but it's nice to see that this assumption is verified. And I think it's something that hasn't been directly demonstrated in this fashion. Okay, we also see that most other variables are not significant here. The sales number is interestingly positively related to default frequency. So apparently larger companies are do default more frequently. Okay. Okay. So this is our first key result. Monitoring does decrease default. Okay. Now, what happens with this distance variable, and how does distance change monitoring in a crisis and outside a crisis? Okay, so again, we try to first look at this in the univariate comparison, and for the distance variable that measures the districts, remember? Okay, so is it in the same, is your bank in the same district or not? Okay. Now, this is the average of the, these are the lenders that, column 2 is the ones that are in the same district, and column 1 is the ones, column 1 is the ones where the borrowers are not in the same district. Okay, so here we see that the borrowers that in the same district are monitored more than the borrowers that are not in the same district. Okay, so that's one of our predictions. Okay? Given that travel is expensive, we would expect that close by companies are monitored more when monitored more. Okay, now in a crisis, this effect inverts. Okay, so this is for our crisis years. So in these crisis years, that doesn't really correspond. That doesn't really correspond to our in the univariate comparison. That doesn't really correspond to our results. Also, the crisis year, actually, the borrowers that are far away are monitored more than the borrowers that are in the same district. Okay, so here we have to explain something else. This doesn't come out in the multiple regression.
Professor Troege.
Yes.
Professor Troege, I think you make a mistake.
Go ahead. Yeah, sure. Yeah.
One means out of district. Yeah. One is out of district, and 0 means lender and borrowers are in the same district.
Okay, very good.
Yes.
But then
one means also, they are in different districts.
But
so in normal time, it seems that lenders, when the lender is in a different district, the borrower is monitored more.
Okay.
But the relationship inverse in the crisis.
But of course,
And
this is
later
not,
in the regression, we will see that the difference, this higher rate of monitoring in normal time can be explained by, because these firms have higher interest rate and higher loan amounts and other things. So yes, so everything is kind of endogenous here. So that's why.
But I mean, it's quite nice to see that the difference.
But in crisis, yes.
You wanted to say? Okay, so that's good. So let's maybe directly go then to the regression results. Huh? So here we have this multiple regression where we explain monitoring with the same distance variable and interact this with the crisis term. Okay, and we get again that distance. Now distance is negatively related to monitoring, as you explained. Given that we have the control variables, like for example the size of the companies, which is very strongly related to the monitoring intensity. So indeed, so the faraway companies have a larger size and therefore are more monitored than the close by companies. And then, of course, the interesting effect here is this interaction. So in the crisis, monitoring also increases, which makes sense. This is, again, what our model would predict. But the interaction term between the distance and the crisis is negative, which means that companies that are, so am I interpreting the, so X distance is 1 means this is far away, no? So that means that in a crisis,
that's true, yes.
Yeah, in the crisis, the faraway companies monitoring decreases, whereas if you add up these two terms, it's almost the same amount, but you can see that there's still a small, probably not significant increase of monitoring in the crisis for the close by firms. Okay, so prices increases monitoring, but for the faraway firms, it increases much less than for the close by firms. And that's our key, that's the second key result, and that's again directly consistent with the economic model. Okay, how much time do I still have? Now we can replicate the same result with our second distance measure, and we get more or less the same results. Okay, so do we have, okay, so this is the interaction terms, okay, and we can again see that the interaction terms have a negative sign, which has the same interpretation as before. So the further away, the more the monitoring decreases in the crisis, whereas overall in the crisis, monitoring increases. Okay, so again, that points towards the fact that monitoring is reallocated differently in a crisis and reallocated more to the close by firms than and decreased on the faraway firms. Okay. And gender is male is 1, yeah. So for some reason the male borrowers are less monitored, which is surprising because apparently they are more risky. But there may be other factors going on here. Okay, so these are our key results. Okay, so the 2 key results are really that default frequency goes down by monitoring significantly, and that the monitoring changes in the crisis differently for firms that are far away and for firms that are close by. It increases for firms that are close by, and it has tendency to increase less or decrease for firms that are far away. Okay, so as a conclusion, simply monitoring significantly reduces default risk, which I guess on its own is already quite innovative and I think has never been shown in this way. And our second takeaway would be that this limited monitoring capacity can explain fluctuations of credit standards and lending distances across the economic cycle, because in a more risky economic environment, the monitoring will be reallocated closer to firms that are close by, simply because there is no time to waste for trending. Okay, so I think I'll stop here. So we have 15 minutes for questions.
Yeah, thank you very much for the presentation. We have a question from Nga.
Okay. Hi. Thank you very much for your presentation. Yeah, it's really interesting one. However, I have some questions. Actually, just something I'm curious. Can you go back to slide 25?
25.
Yeah.
Let's see. Which one is this? Oh, this one.
Yeah,
Okay.
this one.
Mm-hmm.
Yeah, thank you. I'm just curious about the way you classify the distance from the bank to the distance. Like you classify from 0 to 5 and 5 to 10. And this one is the data of the whole Vietnam, right?
Yes.
Yeah. So I don't know, but I'm just thinking like in Vietnam, for different city, we have different meaning of distance. For example, my hometown is a very small one. So the distance between the bank in the big city should have different effect in the largest city like Ho Chi Minh City. So I'm just thinking that did you control for the city in your analysis?
I think we have the province, but we don't have the city. I have to ask Yep again, who has worked more with the data. But I don't think we can do this with data.
Actually, the data is surveyed from 9 provinces in Vietnam.
Yeah.
And we actually include location effects, location dummies in probability regressions and location fixed effects in OLS regression. Okay. And so I think this issue is properly controlled for, even that in Hanoi we have information whether the firm comes from, the survey firm comes from Hanoi or Ho Chi Minh City or other provinces. So I think this issue is already properly controlled for.
Okay, so you classify.
But it's true, if the firm.
Yeah, go ahead. Sorry. Yeah, sorry.
No, we only have fixed effects for that. We control for location fixed effects. So we actually have we actually know where the firm comes from, whether it's from Ho Chi Minh City or Hanoi or Phú Thọ province or other provinces.
Yeah, okay.
I mean,
so we control for we have fixed effects for that.
Okay. Yeah.
Also, I mean, this should affect the overall level of monitoring, but probably not the way it changes with distance. No. Yeah. I mean, it will change with distance. It's still change with distance, and that's actually what we're trying to show.
Yeah. Thank you. I also have some curious about the variable. Can you go back to the variable list slide? Sorry. Yeah.
No problem.
Yeah.
Yeah.
So I saw something about ethics. So in your variable, you say the first one, if the manager it have the Chinese rooted or not. So I have 2 questions here. So I don't know why we include Chinese here. We need to classify Chinese and Vietnam, not international, different nationality in Vietnam. Maybe we can go slide number 8. I don't remember so well. Yeah,
number
maybe
8.
Number 8. Yeah.
I mean, it's just a control variable. We have no particular prediction. Slide 8.
Yeah.
No. This one? No.
No, sorry. Yeah. the list of variable I don't. Yeah. I can see. I have to cross it.
The list.
Yeah, maybe 1 or 2 upper, one or 2 previously.
Previously, this one.
Yeah, this. No, not this one.
Summary statistics or the variable. No, this is the only one we have. Huh? So we have a very small percentage of ethnic Chinese origin. Huh? And this is a control variable that previous students have used, and that's why we have thrown it in there. But frankly, no particular prediction on what this variable should be or what it should do.
Yeah.
And given the very small number, also, I think.
Yeah, that's why I'm curious.
It's largely irrelevant, I think. Yeah. Probably should take it out because it's just going to raise questions.
Yeah, that's true. Yeah, that's I'm curious. And another thing about the age of the manager. Why you cut it at 40? Is there any reason for choosing them more than 40?
In the model or in the?
Yeah, you have the explanation table for on variable. I think some fields, some one or two.
No, we don't cut it. Huh? We definitely don't cut it at 40. The average age is, I think, 44. No.
Yeah.
So, so there's definitely some managers that are older than 40. Okay, and the oldest one is 78. Look, here's the youngest one is 21, and the oldest is 78.
Yeah.
So we don't cut.
Okay, so you cut more than before.
No, we don't cut. We just have it as a control variable, and again, I think it's a control variable that doesn't really do anything. I mean, you could expect that this is related to default, but it's not. Look, I mean, it's negatively, but totally non-significant. So it's as a control variable here because previous literature has done it, and because we have it available, but we could think about not presenting it or taking it out. I'm pretty sure it's not going to change.
Yeah. Thank you. And also in this table, we go with, I think, also the same story because the number.
Yeah, so it's slightly significant, which means that yep, I have to ask you again. So this means the Chinese origin have a slightly lower default frequency. Okay.
Yeah, but from the description table.
Actually, in the survey there are the ethnic minorities people as well.
Okay.
But the problem is there are only like 8 or 9% of other ethnics. And most of the observations are from Kinh people, either Kinh people, Việt people, or Hoa people. So to keep like 7, 8, 9 observation from other ethnics doesn't make sense. So we decided to exclude these people from the from the sample. And for ethnic, it takes the value of 1 if the entrepreneur is from Hoa people, is a Hoa people, is a Hoa person. So this result shows that Hoa people actually default less than default less than Kinh people. So they may have like a different kind of, Hoa people, they have different business network. They have different business network and they have different behavior. So maybe there's something about them that make them default less. I don't really know, but obviously it's a question for behavioral finance. But it's what we find, but we don't really dig into that.
Yeah, because I'm doing in behavioral finance, so that's why I'm curious about this one. And also, when you define people, if they are Chinese rooted, so how can you define it? By their nationality or by something? Because in Vietnam, like in Ho Chi Minh City, even
no, they are Vietnamese Hoa people. They are Vietnamese Hoa people, not Chinese people.
Okay.
In the survey, they asked the entrepreneur to review their ethnic group, and they are Vietnamese Hoa people.
Okay, thank you.
Vietnamese Hoa people means okay,
Okay, thank you. I'm clear. Thank you.
Thank you, Nga, for excellent question. Any more questions from the audience? So actually, I myself have some, I think just some remark on the following slide, or maybe on slide 27 regarding the determinants of monitoring. So actually, it's not the purpose of the research, but maybe the enterprises should locate, should choose bank from between 5 and 20 kilometers from their firms to avoid to reduce monitoring from banks. according to the result we can find here, right?
To reduce monitoring, because in the direct regression you find that
in the regression, if we have the distance between 5 and 10 and 11 to 20, we have lower monitoring impact on the firm. So a way of cheating for the firms maybe. And another, I think it's kind of funny fact in Vietnam. I think other Vietnamese men here can confirm regarding the gender impact on monitoring. I think that men in Vietnam have very popular informal networking after work. And I think even for work-related issue, they discuss during that networking moment. And therefore, for formal monitoring,
less necessary.
We think that we can have more with women, female managers. And
because you think there's more informal contacts between men, and therefore they don't need as much formal monitoring. Is that
yes, they solve any outstanding problem within the informal networking event. So maybe you can even develop a new topic around entrepreneurs, gender, and relationship with banks.
No, so it's interesting that you're right. So I mean, if the company is more than 5 kilometers away, they have less monitoring than if it's very close. So the which is in our theory, but then the more than 20 kilometers is not significant. So that's actually quite in line with our theory. So so the further away you go, the lower the monitoring, because the traveling costs or the monitoring costs are more important. So and it increases. So the coefficient increases, and that really means that the monitoring increasing intensity goes down. So I mean, I'm not sure. I mean, we assume somehow that this is exogenous. So we don't really model the choice of the bank. We just assume that this is determined by maybe simply availability of the bank. This is the next bank that is available, or by other factors. So I mean, that's of course always a concern, the endogenous choice of the bank firm relationship. We haven't really thought about this for the moment. We have enough other things to do, but I mean that's the usual endogeneity problem that you always have in these kind of studies, of course. No more questions?
Any more questions or comments? Before the presentation, I got questions from some friends already, but maybe they are shy and they are still thinking how to.
I mean, the paper is really in an early stage, so if you any kind of suggestions is very welcome. So. Maybe I should. I mean, it's we'll see how it goes. But there's one. I wouldn't say competing paper, but there's a paper that has the same observations, that these lending distances fluctuate, by Raghurajan with co-authors. So he's of course extremely famous. He has been the head of the chief economist of the IMF. And he explains this with very strange, I think, theory, where he says that it's linked to the competition of banks that changes with the credit cycle. And if there's too strong competition in an area, the banks will migrate into other areas. I think it's a very far-fetched explanation. I think our explanation is much more convincing, but that might make it complicated for the paper to be published, but let's see. There's another question.
We have a question again from Nga. very curious.
Yeah, sorry, this is me again. Yeah, because your research really interesting. I'm also Vietnamese, so that's why I'm curious. Something also not the star of your story, but also about the control variable. Do you control for firm size in your analysis? Firm size,
assets and sales, no?
Total assets.
Log assets and log sales. Yes.
And
so I've cut the tables. There's many more. There's many more. I should probably let me see. Yeah. We can show the entire table, but I've cut some of the control variables that you're mostly interested in, apparently. But
yeah, because like in Vietnam, as far as I know, for example, the way of the real estate firm they borrow money is also different from different industries. So that's why
no, it's manufacturing firms here. Really? It's a survey of manufacturing firms. In this sense, it's no real estate firms.
Okay.
And we do. I mean, real estate firms, they use a lot of collateral, obviously, so that we correct for, we control for. But it's manufacturing.
Yeah, sorry, I missed this part. Okay.
No. It's the name of the survey. I didn't really point it out, but yeah.
Okay, thank you.
Thank you, Nga. So actually, I can say that thank you all for the first of all to the speaker for the very interesting topic and about our home country. Most of the participants here are home country Vietnam, and able to understand more about the lending and monitoring practices in Vietnam, which can of course be applied in other countries, not only limited to Vietnam. There are of course many other aspects to discover, as you say. Why not utilize data of Vietnam to get the edge over the overused US data or global data, and if we have interesting topic, we can have very nice application with this new data. And also thanks to all the participants. We know that today is very close to the winter holiday, so maybe many have left early, and those who are here are very yeah, they are really motivated by the topic, and as you can see, one young researcher like Nga, I'm working with her on some idea as well, and I think maybe in the future we can have some co-work with her. It's very active and very hardworking.
It's my pleasure. Yeah, thank you,
Miss Nga. Actually, Professor Troege and I have several other papers about Vietnam as well, about credit and Vietnam as well. If you are interested, we can send you for reference, because we are interested in the Vietnamese market as well.
Yeah, sure. That I'm really happy about it. Yeah, so feel free to drop me email. How can okay, I will send you an email after this seminar. You have your email, or I can get it from Yang, right?
It is on the paper, so you can get it from Yang.
Yeah.
As the team members know, it took us a long time to invite you. I think almost 1 year. So I hope that in the future we can invite you again, because we can see your interest in Vietnamese data, and your interest to collaborate with researchers from developing countries, in particular Vietnam. So we are looking forward to a lot of fruitful collaboration in the future. Thanks a lot.
So do I. Okay. Well, thanks a lot for the invitation. Thanks for your patience, for listening to this not very finalized paper.
Actually, I think it's the purpose of discussion to see together what we can explore further, and it's already a very well-developed paper. We learn a lot from it.
Yeah, it's really interesting. Yeah.
Thanks a lot. Okay.
So have you taken some picture as for the souvenir?